Good afternoon, everyone. Just get my slides up on the screen. Hope you're well. My name is Alex Harrington-Griffin. I'm the CEO of TrustedLand, and welcome to the November virtual forum by TrustedLand, supported by LandTech and attended by you lovely people. Haven't had a chance to go and say hello to many of you just yet, but thanks very much for turning up on time, and hopefully you've had some good catch-ups with your colleagues. Most importantly, thank you very much for dragging yourself away from the US elections. I'm sure, like many of us, you've been slightly curious to see how our friends beyond the pond vote and use this opportunity to maybe give themselves a fresh start. We're just waiting for the final 8 or 9 states to count down votes. We won't be bringing up the results if they do happen this session, but if anyone does happen to catch in the background and wants to let us know in the chat, please don't feel shy. I am very curious. Welcome to Remo as well. This is, if you haven't been here beforehand, this is our unique networking platform. We are in presentation mode now. When we're not in presentation mode, you will have the opportunity to be able to jump around different tables, say hello to your peers, gather some information, eavesdrop on some interesting conversations like I did very briefly about developments in receivership, and hopefully make some interesting contacts, especially as we go into this lockdown 2.0 starting tomorrow. And I hope many of you have managed to prepare and get everything you need to get done before that starts. I know many of you are very good at adapting and found a new good system and way of working now as well. So our job today is to inform you, to bring information that we think is relevant at the moment. Obviously, developments in receivership is something we touched upon 6 months ago when the pandemic first happened. And I think it's an important chance for us to update our knowledge and understand what's going on as well. So we've got some excellent guests who are going to bring us up to speed. And of course, from TrustedLand's perspective, our job as always is to identify, showcase and champion those real property developers, those real property professionals that are doing amazing things in the space. And we look forward to sharing some of those updates with you today from the TrustedLand community. So if you do have any technical issues today, Juliana Rocca is here. She will support you. She's on the tech table if you need any help. If you want to open up my slides so you can get rid of myself and just see the slides on the screen, there are 4 small arrows at the top window, right-hand window, to enlarge your screen. You can do that at any point through any of the presentations today if you want to focus on a particular screen as well. Let's go through the agenda for today. So first of all, we're going to have the insolvency update from David Kerr. He's the former CEO of the Insolvency Practitioners Association, has been a great advisor to TrustedLand. Many of you would have met him back in February when we did our TrustedLand live update and the opening of our fundraising round as well. And David is going to supply us with a bit of an update in terms of what's been happening with the government sort of schemes that have been put in place to help businesses, and also understand which of those are now being prolonged and which of those are still due to end as we'd expected originally. We're then going to move on to our main feature for today, which is at 4:35, which we've called Developments in Receivership, with Colin Jennings, who is one of the partners at Sanderson, Weatherall, one of the big receivers in the UK, the biggest in fact. And we invited one of our members, Mark Passfield from Adar, to come and join me to talk a little bit more about the construction side and help me out on some of the construction related questions that are involved when you're potentially taking over a part built site. We then have a bit of a tester session. We've got some pre-organized meetings that are happening from 10 past 5, and you have the chance to get involved in some open networking as well. And then everyone will be invited to stay on Remo for as long as they'd like, to have some further catch-ups and jump around some of the other tables as well. So thank you, Kieran, for your message. Do feel free to use the chat throughout the session and drop any notes, any questions. We have also got the Q&A box, so if there's any questions that come up, these sessions are always made better when you can contribute, when you can bring your questions in. So please don't rely on myself and other guests to sort of purely come up with all the content for today. If there's anything you want to know, no matter what it is, please do drop it into the Q&A, drop it into the chat, and we'll do our best to get around to them through our sessions today. Just in terms of some of the trusted wins we want to go through. So every session we go through some of the trusted successes of the members. So I'm just going to read a few of these out for you today. Typematic have just finished working on the soft brand launch of Schema Engineering. It's a new company set up by civil engineer Phil Pritchard, who's involved with LK Studio. Well done to them. Pegasus Group have secured planning permission on behalf of Elgin Energy for a solar farm on the site of a former World War II airfield in Grafton Underwood. Very interesting, a little bit of a change of the normal Resi scheme that we look at here. We have Planning Insight, who have won an appeal from Thanet District Council, my first time mentioning that, for the subdivision of a large home to create 2 new family dwellings. And they also have another win in terms of they've managed to overcome a rejection from a site in River Welland for a substantial outbuilding on the bank of the river there. Tariq Mubarak has just completed the exchange of contracts on a £7 million GDV site in Balham with planning for one of his clients. And I did think this was quite impressive. It involved a share purchase of the property owning company that owned the site. And he got it done in 2 weeks from heads of terms to exchange. So fair play to Tariq. Tariq was involved in the Developers Investment Group over the summer, where we were exploring different opportunities such as receivership. And obviously one of the absolute keys there is making sure you can move swiftly. So well done to Tariq and his team. Crowd Property, they have just achieved their £100 million lending mark, which I think is an incredible achievement in the peer-to-peer space. It is obviously an emerging space, but one they've really, really solidified. So well done to Crowd Property, Michael Bristow and their team. They're our partners for the TrustedLand Awards back in August, for those that attended. And the deal that took them over the 100 million mark was a 9-unit mixed-use scheme in Brentford, 9 apartments, 2 commercial units, which was funded by 1,007 investors in just 15 minutes. So well done to them, and glad they are funding some projects near me. Formed Architects have just got planning approval after persistent chase of the local officer, that's their words, in South Buckinghamshire for an extension in a conservation area. Well done to them. And finally, Orium Finance, Dean and his team have helped one of their clients to refinance 2 projects, including one using a civils loan, which basically means that the government will pay the first 12 months of the interest and all the fees, which I've understood, which is pretty incredible as well. So definitely, if that's something you need to look at, a refinancing project, definitely have a chat with Dean and his team. Well done to them. I did see also a great photograph of Dean recently sharing lunch with Dominic Grace, head of residential development for London, from Savills, redeeming one of his prizes from the very, very generous donations that Dean and Orium Finance made during the TrustedLand Awards raffle that he picked up. So I'm glad that happened before the next phase of lockdown. Just in terms of a win for the TrustedLand side, we were very, very proud this month, or last month, to go through a few unique experiences and to be able to bring some of our real developers with us through the experience. So we were invited by the British Property Federation to bring 6 of the real developers to speak to the Housing Minister, Robert Jenrick. It was a very, very interesting session. We did it via Microsoft Teams, as you can see here. And we all had the chance to put a few comments forward, a few suggestions in terms of the planning reform, the planning white paper, as to what really SME developers would like to see happen. So well done to those who took part, and just a shout out to Archco, Chopper Property Group, Millbank Group, Pocket Living, OpenView and Fleet Homes for their contributions. And a big thanks to Planning Insight, Pocket Living and the British Property Federation for helping TrustedLand submit their first formal response to a consultation, which we did via this planning response for planning, formal response to Planning for the Future, which was a weighted letter. If you want to get hold of the results from our poll to see what the SME developers suggested, what they wanted to see happen, and what we have put forward as recommendations, Juliana will put the link into the chat right now, and you can see the letter that we sent to MHCLG last week. Moving swiftly on, in terms of Real Developer 2020-21, registrations are now closed. We have got to the stage where we're now processing the last few registrations and issuing the final placements. Thank you to everyone who took part, who nominated, who recommended, who shared content. We've had some great registrations, some great coverage in places like Estates Gazette, and we have some great firms to recognise as part of 2021. We obviously won't be revealing the full 100 until the new index comes out in January, but just to give a little bit of a shout to those 10 premier developers who will be taking part in a very special program, meeting some incredible property CEOs, legends, entrepreneurs, and captains of industry to gather sort of advice and inspiration for how to grow their property businesses next year and secure their legacy. So big shout out to the various brands that are there. We look forward to working with them and celebrating more of their work next year. And for those of you who are involved in site finding, who are involved in any sort of deal opportunity, we have collected the current deal requirements of 28 of the existing real developers. Together, they have £133 million in equity available to spend, and they have given us the top requirements. So if you haven't already got a copy of it, please, Juliana, we'll put the link into the chat now as well. You, after this session, go register. We'll send those out to you as well. We are just making sure that we understand who the parties are. These are not going out to randoms. We don't want these developers to be harassed with opportunities that don't stack up or aren't right for them, but we will release them to known parties if you're interested. So there's top requirements of 28 of the existing real developers. Do grab hold of that as well. It's a very useful document, and we'll be producing an updated version in January going into 2021. Just a quick one to finish off with, just for your diaries. This is sadly the last virtual forum session that we'll be covering formally for this year. The next one will be January the 6th. We'll be back with a very special session covering things that, a topic which I think is going to be prevalent for all of us, regardless of how long the pandemic lasts. I think there's a lot of changes that have come into play into all of our routines that will be here to stay. And in fact, I hosted a roundtable with the British Property Federation last week to explore some of the things that will stay in place in terms of how we meet each other, how we network, the kind of research we do with people beforehand. And this session will address exactly how to make sure that all of your presence, whether it's setting up for a virtual conference like this, to making sure your online profile is as fantastic as it should be, given the fact that you are the real professionals in this space. So without further ado, I'm going to jump in and welcome our first guest on screen. David Kerr has been a great support to us, and a number of the real developers had the opportunity to spend some time with David over the summer. We had a private session for about 11 of them, discussing a little bit about some of the things that were happening in the insolvency space. Obviously, we know as a result of the pandemic, there is going to be some casualties. It is an absolute fact. It is obviously extremely unfortunate, but we have to recognize as entrepreneurs the things that are going on around us, whether this actually puts any strain on our businesses, but also in terms of looking at where certain businesses may be struggling and where we can offer a viable solution to them as well. So David, thank you very much for joining us today. You're going to give us a brief update on some of the things that have happened in the last 3 or 4 months. Obviously, with this next lockdown now formally confirmed and agreed, I think that's still the status as of 4:30 on Wednesday, the day of their votes coming in. Tell us a little bit about what's happening in the insolvency space, and what do you feel that property developers specifically should know about what's going on with the government policies?
Sure, thanks, Alex, and thanks for inviting me to join you. Of course, I realise I'm just Colin's warm-up act, so we'd better keep it reasonably short and brief. Yeah, the most interesting thing, I suppose, to note, given some of the conversations I was having just before we sort of started, is that the general expectation is that the numbers of insolvencies must be going up. The economy is obviously in dire straits, and companies are closing, so of course insolvencies must be rising. Interestingly, the Q3 figures have just been released by the Insolvency Service, and they show the number of company insolvencies reducing by nearly 10% on the previous quarter, and reducing a staggering nearly 40% on the same quarter last year. So not only are the numbers of insolvencies of companies not going up, they're actually going down. We're seeing fewer insolvencies than we would ordinarily expect, which is pretty staggering, but perhaps an illustration of the success of some of the measures that the government has been putting in place. Obviously, we've got furlough, we've got loans, we've got all sorts of support that is being provided temporarily. And as we will have heard over the weekend, some of that's been extended. So furlough, of course, runs for another month to the beginning of December. Those loans have got longer time to repay when they kick in next year. So we're going to see an extension of some of those provisions. But inevitably, as you suggested, there will be more corporate casualties. Insolvency practitioners are expecting to be busier. It's just a question of when. Perhaps now that won't hit until the first quarter next year. I don't think we should kid ourselves. A lot of companies, of course, will be taking advice, and insolvency practitioners are, reporting that they're seeing a lot of engagement with companies that are struggling, but they're not necessarily, of course, at this stage pushing them into formal insolvency. One of the reasons why perhaps directors haven't felt the need to put their companies into insolvency, particularly over the summer or in the 6 months from March, has been because there were some temporary measures introduced in the Corporate Insolvency and Governance Act that came in the back end of June this year. And one of those was sort of a reprieve, a stay in terms of any director personal liability, which would ordinarily kick in if directors are found to trade their businesses whilst knowing them to be insolvent. So historically, that would have caused practitioners to be saying to directors, if you carry on beyond this point, you're potentially putting yourself at risk. And because the government wanted to encourage directors to keep their companies going during the pandemic, where they could do so, but the only reason for a problem was because of COVID, they were encouraged to keep them going and not put them into a formal insolvency process. And while some of the provisions that were put in place through the Corporate Insolvency and Governance Act have been extended beyond September up to the end of December and into the new year, this provision in relation to directors and their personal liability has not been extended. So that sort of cushion, that protection for them, fell away on the 30th of September. So we may yet see, whilst the numbers of liquidations largely account for this drop in insolvency numbers overall, we may well see now, as directors are advised about their company's financial positions, that they will once again be warned that if they carry on and incur further losses, knowing there to be a problem, that they would face personal liability. And we may therefore see that sort of work its way through into an increase later this year or into the first quarter of next. That piece of legislation in June introduced also some new permanent procedures into the insolvency regime. So we have a new moratorium and restructuring plan that's available, a bit like the Chapter 11 process in the States. Not been widely used. It looks as if it's going to be used by the bigger companies rather than SMEs. And we also saw some discussion as that piece of legislation worked its way through Parliament on the sort of vexed subject of pre-packs, which tends to dominate the news. There have been quite a few write-ups in the Times recently about various pre-pack cases. And the concern there is where there's a quick sale by an administrator involving individuals who were the directors previously of the bus company, so a sort of Phoenix type situation. And going forward, we're now expecting, because government's recently published some draft regulations, we're expecting to see some changes there. Effectively, we're going to get an independent opinion by somebody not connected with the insolvency practitioner and not connected with the prospective purchaser, to give creditors a bit of comfort about those transactions. So watch this space for that one. There are going to be some changes coming in the new year, which we might need to pick up in more detail in a subsequent discussion, but we're going to see HMRC taking the lion's share of whatever's available in some of these insolvencies, because they're going to start claiming, again, as a preferential creditor for the PAYE and VAT outstanding. That kicks in May. We're going to see some changes in the personal insolvency sector, where we're going to get a new breathing space and repayment plan for individuals who get into difficulty. And we're going to see some published information by government on the way the insolvency sector is regulated. That probably won't come in until the back end of next year or even the beginning of the year after, but the proposals will be published probably in 2021.
David, can I ask a question, just as we're squeezing into into the end of time. I'm always interested about the types of businesses that are going through some of these pressures. And obviously, there's no prizes for guessing that high street retail, certain hospitality businesses are under pressure. The numbers you've presented at the beginning, the 10% down on last quarter and the 40% down on the same quarter last year. That's massive. Do you have any indication of what kind of businesses are the early sort of movers in terms of reaching that insolvency space or point?
I think at the moment it's probably not the sort of standard. We're in a different kind of space at the moment, aren't we? But yeah, retail is right up there. And interestingly, we've seen the use of a company voluntary arrangement in a lot of these high street retail and food chain insolvencies. And the one corporate insolvency that has gone up significantly in Q3 is the CVA. So that at the moment seems to be the one where there's more activity. We need to bear in mind the fact that if it comes to buying property from an administrator or liquidator, Colin's going to talk a bit about property receivers shortly. They're going to be busy. They're going to want a fairly quick turnaround, probably a fairly quick disposal of assets, and they're going to want to deal with people who can move quickly and have got the funds available to transact. So I think just bear in mind that if you're engaging with insolvency practitioners, particularly as we move into Q1 next year, they're likely to want to execute a transaction fairly quickly.
Well, that's it's certainly been repeated advice from the receivership space, from the insolvency space as well, and hopefully those real developers who have spent time with us and those that have interest in the space have sort of got that firmly in their minds now about some of the fundamentals they'll need to make these deals happen. And they are opportunities. We are in an entrepreneurial space where we have to look at the opportunities where we can stay ahead of the curve and make sure we find something that has the right kind of margin involved. So it always feels a little bit sort of tongue-in-cheek to talk about these as opportunities when it's other people's negative situations, but we have to recognize that this is going on, and we have to make sure that if we are the right people to go and pick up pieces and help people move on or help a situation move on, then we've got to do it properly as well. David, I could talk to you all day about the ins and outs of the government program stuff, but we've got to move on to our next feature. So I really appreciate you sharing with us as well. Obviously, you do a fair bit of consultancy work. I know you've had some sessions with one or two of the real developers as well. So for anybody who wants to follow up with David afterwards, obviously you are on LinkedIn, and we can share some details as well if you do want to follow up with David and get into any more conversations around the insolvency space, and even just to ask you about some of your amazing work with the World Bank as a consultant now as well. So David, thank you very much for joining us. Much appreciated. Going on to, just before we kick off into our main session now, I do want to invite our new head of the Trusted Land Committee, Richard Pugh, up to join me. Interesting enough, hopefully you did see a couple of the videos that we shared earlier this week on LinkedIn, which was a brief conversation between myself and Richard in a circumstance exactly like this, in fact, which seems to be quite familiar with our interactions nowadays. Discussing some of Richard's work in the administration, working with distressed deals and distressed sites as well. So if you haven't seen those, well worth checking out to learn a little bit more about Richard's experience in working with sites and administration and some of his key learnings from there as well that could be stacked on top of David's advice, and I'm sure the advice we'll pick up later on. So I've invited Richard up here just for a moment, just to share some interesting updates with us about the committee for 2021. Hello, Richard, and I'll hand over to you.
Thanks, Alex, and thanks for the opportunity to say a few words. So I'm thoroughly looking forward to taking on the new role as head of committee, and I'm also delighted to confirm that we have the team set up now, so that the committee is in place, and the committee members are Mani Chopra from Chopra Property Group. We have Nick Cuff from Pocket Living, Rove Sharma from Finura Property Solutions, Jeremy Leaf from Jeremy Leaf & Co, John East from Kinley, Fulcard and Hayward, and of course myself. So it's I'm a dynamic group of 6. I'm really, really thoroughly looking forward to working alongside such an experienced group of people. It's going to be great fun, and I'm really honoured that they've committed to being part of the team. So thank you to the 5 of them, and thanks, Alex. It's a nice challenge for the year ahead.
Wonderful. We'll certainly give you plenty of things to talk about as well. But well done to the committee, and thank you to everyone who has taken up the call to arms to take on this very, very important role. The committee has always been an important part of making sure that we sense check what we're covering, what we're providing, looking at the value that we look to bring to our members, and obviously to keep us on our toes in terms of getting some frank feedback as well. So Richard, we're very, very honoured to have you steering that team, and thank you very much for putting an awesome squad together.
My absolute pleasure. Thanks, Alex.
Wonderful. Thank you, Richard. Good. Now I will jump on to our main feature for today. We have structured the session slightly differently to make sure we can get straight into the action as well. So at this point, I would like to welcome our 2 guests who are going to join me. So I'm co-hosting this session along with one of our members, Mark Passfield from Adar. Mark is, just to introduce him, is the head of quantity surveying and project management at Adar. He joined in 2005 and became a chartered quantity surveyor in 2010. And he currently oversees the quantity surveying department, in addition to providing valued services, surveying services to their clients. And we are very, very honoured to have with us today Colin Jennings, who's board member at NARA, the Receivership Association. We met Julian Healy, the CEO of NARA, back in April when the pandemic first kicked off, and a partner at Sanderson Weatherall. And just to give Colin a little bit of an intro so we can get straight into the action, Colin is partner at the National Surveying Practice of Sanderson Weatherall, having previously been an equity partner at Edward Simmons for 25 years prior to their acquisition by LSH. So Colin, Mark, thank you very much for joining me today. We are very honoured to have 2 awesome guests to get into this very, very topical subject. And I think just to set the scene, we have called this session Developments in Receivership, which in a way feels a little bit morbid when we're talking to a group of SME property developers. But at the same time, the purpose of it is, first of all, to look at the trends, the occurrences in the space and what we need to be aware of. And Colin's going to give us a bit of an update in terms of what him and his colleagues are seeing at the moment. And then to actually dip into a couple of case studies that Colin's actually working on, looking actually at developments that are in receivership to understand the circumstances, what does a case like that look like, and obviously what is going to happen to those. So for those partners that, or those of our members that may be considering working in this space, are exploring it, are interested in getting involved either as a service provider or a potential buyer, that we can make sure we understand the intricacies of these kind of projects. So Mark and Colin, thank you very much for joining me today.
Hello, good afternoon.
Wonderful. Colin and Mark, I've given you a little bit of an intro, so feel free if you want to add any context to your sort of intros today. And Colin, I think you're going to share some slides with us just to give us a little bit of context.
Yes. I'm just we didn't cover this off the other day. Where do I bring up the slides, Alex?
So you've got at the bottom of the screen, it should be next to your camera mic, there should be a button for share screen.
I've got it, yes.
And it'll give you a choice of which screen you want to cover off. So just while Colin's setting up, Mark and I have had a few conversations about how we sort of make this as sort of relaxed as possible. Obviously, we are getting to a very, very serious subject here. But what we're going to do is we're going to sort of jump in with Colin at any point where we feel that either we want to understand a subject a little bit further, or if you want to put your comments or questions into the chat and the Q&A, feel free to do so. We'll pick them up and we'll try and jump in at a relevant point to build the conversation out. And as always, this is an area that I've spent a little bit of time in over the last year or so, in fact, year and a half. But it doesn't mean that, there's certainly everything that we understand. And I'm always a fan of making sure that even though something sounds simple or sounds like you should know it, don't be afraid to put your questions in. And Mark's been briefed with the same account. So, okay, you've got looks like we've gone into the inception here. Let's have a check here.
I'm trying to find my slides, Alex.
Okay, if not, I can actually share my screen. They haven't changed since previously?
No, they haven't. No, not at all.
Okay.
Yes, that will be a lot quicker with my IT skills.
Okay, well, Giuliano's jumped in also. Giuliano is our little saviour whenever we do have a little bit of a challenge. So give me 1 second. I'll bring your slides up.
Well, just before while you're doing that,
Yeah.
and following on from which is my non-scripted bit anyway, following on David's comments, I would reiterate those 100%. I'm not an insolvency practitioner, but I'm speaking to that insolvency practitioners most days of the week, and most of my day-to-day practice is insolvency as a LPA receiver. The market has been very quiet this year, and in fact, discussions that I've been having internally is we've been working through our backlog of cases that are still there from 2008, 2010, 2011, whenever you feel the last recession finished.
Right.
And there's a reasonable amount of advisory work going on. I think clearing banks certainly are fearful of being seen to be pressing buttons on appointments. I think other banks or lenders is probably a better description, are less concerned about their public perception. If they may not even have a public perception from the general public's point of view. So there hasn't been a lot of appointments across the board, but I think the view is yes, Q1 next year. Although if I've been having this conversation in July or August, I think the view was November. So that's shifted out a quarter, and we could see with the next 3 or 4 weeks coming up for you in England at least, that Q1 could shift backwards. So that's a sort of just a follow up really from David's perception comment.
Okay. We have got your slides up on screen. If you want to press the stop sharing, then Juliana has kindly jumped into action to share them.
That's it.
There we go. So you can just guide Juliana as we go through. And
I think we can skip over that one, which is just an introduction, and I think we can skip over that one. Oh, sorry. Yes, that's the one I was going to start on. The second one was we covered in terms of introduction.
And Colin, just to cover off, if anybody wants to enhance that particular screen as well, you can click the 4 hours, and obviously it will jump up as well. So, sorry, Colin, go ahead.
I was just pulling up that screen in full to see just check I'm on the right one. This is just an overview of the marketplace, and I think you'll get a different view from different people. So I think this is very much my view, but perhaps the Sanderson Weatherall view and how we're finding things. My first comment: has COVID affected the market? I think it's very difficult to generalise. Partly because I think there's been very few transactions to a degree, and I'm a valuer by training, but I would be very fearful going out doing valuations at the moment because I think if you're right, I think you're lucky. So I've looked at this as on a sort of sector by sector basis to sort of put a bit of more meat on the bone. I've started off thinking about residential. I think a good number of you are in the residential market, so by all means, welcome your views on this. My own take is a bit of a mini boom, and certainly in my part of the world, which is North Wales and the Northwest, stuff we've got is selling fairly quickly. Deals that I'll come on to process in a moment seem to be happening. I think it's obviously influenced a bit by the stamp duty. I think the difficult thing in that context is where is the market going to go after March 31st when the stamp duty finishes. I think there's two options there. I think the government could well extend that date, which would just take on any pressures. And I personally think they ought to do that early in the new year, because it will prevent any mad rush around end of March. I also think there's a weight of money in the market, in terms of those that are still fortunate to be in work, which is, let's face it, the vast majority, are probably not spending their money. They're not going to work. They're not putting it into pret-a-manger. They're not going down the pub at lunchtime. They're not going out so much, restaurants, etc. And if there's money being stashed away, it will tend to go into capital projects, whether that be extending your house, moving house, buying a new car. Although I think the buying the new car is reduced because people aren't travelling so much. So I personally feel that my comment of steady as she goes is probably going to be the residential market for 2021. I've covered the stamp duty point, but what I mean in terms of structural changes, and I think this will probably continue, is the working from home scenario. I'm selling some houses, which I'll come on to in the case study, but part of the influence there is people are wanting to get a bigger house because the current house is proven to be too small working from home. The issue that I can see, and it will particularly be the case if the 31st of March stamp duty limit stays, is there seems to be a bit of a blockage in getting through the process, in terms of there's not enough professionals to process, not enough valuers to go and do the mortgage valuations, difficulties in getting searches, difficulties in getting mortgages through the system. And I think that could be a bit of a blockage, which could prove a problem if stamp duty concessions aren't changed.
Colin, I'm just going to ask the audience if they have any thoughts or experiences on this in terms of getting transactions processed, just to put some comments in the chat as well. I'm curious to see what people's sentiments are as well. I know there have been some developers we've spoken to in the last couple of days who have struggled with the help to buy process. Apparently it is very slow and very rigid at the moment in terms of their application process. But sorry, I just wanted to see if anyone else was sharing those views at the moment.
I think from a valuer's point of view, and I had again coming to the case study, I had a transaction downvalued. I think they were getting it below market value, not being knocked back by a further 25 grand, which actually potentially scuppered the deal. And I think valuers are very nervous in that context, perhaps thinking that next year's not going to be a continuation of this year. But I'm not close enough to the residential valuer market to understand what their thoughts are, or to a certain extent what is being dictated to by the bigger firms in that sector. Just sort of moving on to other sectors quickly. Industrial, no change. I think that's limited. There's limited supply in the industrial sector anyway, has been for a good few years because it hasn't been developed significantly. And although industrial users were closed down in the first lockdown, they're not going to be from next week. So that, I think, is not really affected. Offices, I don't think anybody's really taken on board yet what the structural changes are going to be, because most of us aren't working in our offices, and I don't think most companies have really taken it on board as to how they're going to work moving forward. I think it will focus when lease breaks, lease renewals, those sorts of things come along, when people can look at their liabilities and potentially be getting out of their commitments. I think there's a balance here, because I can look at my former office where everybody was cheap by jowl, and there were 6 people on the pod where there's going to be 2, and therefore, even if people only work in the office 2 days a week, they're still going to need the same amount of space. So that I think there's going to be work for office planners and office fitters. The feedback from talking to 1 or 2 agents is there's a demand out there for smaller spaces, which are going to act as almost a regional hub, and those are suburban rather than city centre. So which then comes on to the sort of what I've headed structural changes. I'm not sure how many people are in cities at the moment, or have been, but the last time I went into Manchester in September, it was on a Thursday and a Friday, it was empty. And when that will, even on Friday night, it was empty.
So London's been the same as well.
Yeah, and that's the feedback I've got. So, how they're going to respond, and the office is the sandwich bars. I don't know. I think that is a long-term fundamental change, and how that impacts on inner city living, I don't know. But there's a lot of stock going up and still going up, which there may not be ultimate demand for. I think somebody told me there was 24 cranes in Manchester, and therefore everything must still be going in boom times. The truth is, there were 24 cranes on the 20th of March of part constructed schemes, largely residential. They've got to be finished. When they're finished, I think it will be a long, long time before there's new cranes going up. But that who will tell? I think the beneficiaries will be the market towns, because people will use those more user friendly, less public transport, all those sorts of scenarios. Opportunities, these could be numerous. The 2 that I came up with when I drafted this was pubs to residential. It's a long-standing market change. The other thing is convenience, pubs to convenience stores, that sort of thing. Offices to residential, which is probably contradicting what I've just said about city centre living, but there a lot of that's already happened, and I think that will continue.
Colin, have you seen much with regards to the sort of receivership and insolvency bits and pieces? Have you seen much? Have you seen offices looking to dispose of that asset on a relatively quick basis over the last sort of 6 months, or is that not really occurred yet?
I haven't seen anything, Mark, and I'm not aware particularly of any of my colleagues seeing that. If you're talking city centres, the effect is going to be a lot longer term, because the majority of buildings will be tenant occupied, and therefore the tenant will be committed to a lease, or tenants probably in lots of cases, and therefore all that structure of the leases, etc., has got to work its way through, and that could take a number of years.
Yeah.
The more likely situations will be where owner-occupiers decide that they are no longer going to occupy their office building, and it will revert to an alternative. Well, it may continue as offices, but one of the options and one of the considerations is where does it stand in terms of residential or other opportunities. I think it's a case of, if you're looking at an empty building of any type, it might be offices today, but what are options A, B, and C if it demonstrates that there's no office demand? And that's one of the thought processes that you tend to go through when you're looking at anything fresh.
I think we're going to have an interesting year of challenging zoning and sort of area designations among certain areas as well. You know, obviously a lot of them are designated as business areas, which, you know, may be the areas that are the ones that struggle with demand and occupancy in the greatest degree. So it's going to be interesting to see where that evolves. Colin, I'm keen to get into the case. I'm keen to get into the case studies to have a look at them, because, you know, we've spoken, I think, as a network, and Mark and I spoke about this briefly about the types of opportunities that will be coming around as well. I think one of the things that not many of us have seen is actually, you know, where do sites come to you, and then what is the process that, you know, from when you receive it?
Well, I'll cover that off as a general point. The one that I'm just about to come to is actually an LPA receivership where I'm appointed by a bank just doing it's a single asset vehicle, effectively, just developing a site relatively modest, 17 units. Haven't added up the GDV, but probably about 4 or 5 million quid, that sort of money.
This is the Telford one we've got on the screen now, yes?
What there is a lot of, and I've had quite a lot of involvement, bearing in mind my patches, Liverpool and Manchester, which tends to be more administration driven, have been larger blocks of flats, and you know, I sold a site in Manchester, albeit now 3 or 4 years ago, for, you know, 340 odd flats, and I was involved in one in March. In fact, the site meeting took place on the 20th of March, the last day we could have done it virtually. And I'm trying to remember, that was the 3 sites was about 1,000 units. A lot of those are what I describe as the fractional sales sector, which is another topic in itself, and it's that is really a funding model which is showing signs of strain, and they tend to go down an administration route, as do. Can
you just give us a headline, Mark? Sorry, Colin. What's fractional sales?
It's the model where things are sold off plan,
right,
generally to offshore investors, a lot in the Far East, Middle East, and I've seen up to 80% paid as deposits.
Okay.
And therefore, if you get cost overruns, and the problem has been these things take a long time to sell because they're selling up front off plan. That if that takes 12 months, and in the recent 2 or 3 years, build costs, particularly for those high-rise build blocks, I think one of the ones I've just been was 33 stories in Liverpool. Construction costs have just gone through the roof, probably gone up 25 to 30% since the original numbers were done, and they cease to add up because they're selling them at a discount because they're off plan. In the meantime, construction costs are going up by 30%, and the whole thing, everything gets squeezed.
In a strange coincidence, I think I might know one of the investors involved in that project. Mark, would you agree with that in terms of the build costs? It's a question we get obviously all the time, and Colin, I don't know when that project originated from, but it's one that I've never sort of fully got my head around in terms of the constant shifting, changing. I know we've got a few of the QS members here today as well. What's your view, Mark, in terms of the build costs at the moment?
Yeah, so build costs, especially on what Colin's talking about there, is on the high rise. Build costs have gone up quite substantially, and that's really, some of that is sort of a backfill from Grenville, in that everyone's a lot more concerned now about the fire regulations and making sure that they comply, and everyone's PI insurance has gone through the roof. If anything's over 18 meters in height, then and if there's any cladding to the external of the building, then everyone's taking on that extra risk. So that has caused construction costs to go up. From a low-rise sort of residential point of view, I'd say construction costs haven't changed massively, barring the fact that what we tend to do is, what we've seen with developers, is they're taking on more challenging sites. It tends to be much more sort of, they're concentrating on location. It has been very much more essential because of the fact that we're not providing parking. We need public transport. The sites that we're taking on, or the developers are taking on, tends to be more brownfield, tends to be offices, which are converted into resi. Which, to be fair, actually, the PD cost mechanism is far better than maybe a challenging site, because of the fact that the structure tends to already be there, and that seems to, so from a developer point of view, that seems to pay off, provides a better return, or more certain return, because the structure is already there. And if you add a few more flats on top of the building, which you tend to do because it's got the structure already there, then it really pays off.
Okay, wonderful. I just thought it was relevant to explore that point a little bit, just to see what you've seen from the QS perspective as well. Colin, carry on.
Yeah, coming on to this scheme I'm going to talk through, and it's sort of to try and demonstrate how we turn up on site day two, assess things, and how we work things through. This is, as I said, I've just alluded to, about £5 million GDV scheme. It was commencement date probably about 3 years ago, which probably explains where it is, where it's got to today. We were appointed LPA receivers in July. We turned up literally day two, because the borrower was threatening to strip out all the kitchens and boilers and all that sort of thing. Usual fare from our world. So turn up with locksmiths, get everything changed, etc., etc. It's a site of 17 houses. 5, which include the 2 at the bottom there, no, 7 rather, were virtually completed. 2 of them have already been sold. On the other side of the road were another 10 houses that have been started. Bases were in, some of the superstructure was up. You can see in one of those photographs. But I've subsequently found out that's been dormant for 2 years, which again demonstrates one of why it's in its problems today, because they'd spent, I'm guessing, £500,000, and it's just been sat in the ground for 2 years without finishing off anything, and selling the first phase to cash flow things.
So Colin, did the first 7 that you talked about there that were virtually completed, did they not sell as well? Did the borrower, the bank, did they not come in and say, we're going to complete those buildings and sell them off?
That was the task we were given, Mark. 2 had sold. The bank, the other reason, the background is the director was made bankrupt. Therefore, there was no, and it was a sole director of an SPV. Therefore, the bank had no alternative but to go down a receivership route, because the director could no longer act in that capacity. So we got a quick assessment of the cost of finishing phase 1, which was 60,000 quid to realise the 5 unsold properties, which were probably worth about 1.25 million. So that, from our perspective, was a very low risk assessment. The alternative of selling those 5 houses, we didn't go down that route, but I would guess we would have sold probably at 20-25% discount if we packaged them up and sold them as one lot. So we've done this sort of exercise pretty often in the past, in just doing the last finishing off of projects. The issues that we encountered here, and frankly we encounter on similar situations, the warranties are always at the forefront, because those will normally fall away with the appointment of a receiver or any insolvency.
Is that building warranties as well, Colin, or just you're just talking about the warranties on, say, flat roofs? And
I'm really talking about guarantees perhaps rather than warranties. NHBC being obviously the traditional one. I've always steered clear of them because I find them very inflexible when it comes to dealing with any insolvency type.
They are difficult to work with, but they have already received their cash.
Yes, so they will not continue that. Even if they've received their cash, it is virtually impossible to reinstate them with NHBC through an insolvency process. Others who are perhaps more newer to the market are more flexible, a bit more expensive generally, but a lot more flexible. In this case, we were relatively lucky. We paid about another £250 a property to maintain the warranty, which in the whole scheme of things is neither here nor there. And we got cover from day one, whereas NHBC will not shift from their 2-year position, which is a 2-year liability that I've got. Therefore, I have to keep the appointment open for 2 years, with the bank standing behind me to cover off any nitty-gritty claims that come along normally in the 23rd month. But, there was also here, because a management company situation which had already been party to 2 of the sales, and that was under the control of the same director. So we've had to sort out those. Establishing a new management company, easy, not difficult to do.
Colin, we've got about 6 minutes, unfortunately, of the session available. To go through. What is to go through? Is this still a live case now, or have you guys? You've moved this on?
I was working on it this morning.
Okay.
The phase 1, as of this morning, all those 5 houses are under offer.
Okay. And that's what you guys have progressed with. That's part of your support for.
And we've got prices as good as we expected, not possibly better than on day one.
Okay.
So we've maximised value from that perspective.
Okay. And will you finish the rest of the units on site that are the other 12 that are not finished yet?
Well, no, in a word.
Okay. But
when you're trying to sell those, Colin, what sort of pack of information do you provide to, say, another developer or someone who's going to?
Well, we've sold all of those to owner occupiers, so we will just be going through a normal owner occupier sales process.
But even though they're not finished?
No, we have finished them. We spent.
No, not the front. Sorry, not the front 5. The back.
Oh, the back 10. No, we will provide a normal insolvency contract that you see what you get.
Yeah. Okay. So we had to a number of developers who will go into potentially look to buy that development, which is like 50% complete. And we would, like what you've done there on the front 5, is we would provide some initial costing advice saying, well, look, this is what we think it will cost to complete. This is the sort of benefit of what may be there. And that's just giving our developer, our client, the sort of tools to go and negotiate with yourselves on, essentially. But the concern being, as construction consultants, we always highlight all the concerns. Is that we would be saying, well, where are you with warranties of what's been done to date? What's the stuff that you can't see? What's the damage you can't see? What's the below ground drainage like? What are the status of building control inspections? Like you touched on there, your NHBC, and then what we'll do is we'll add all those elements of cost within into our sort of build up. And one that's always a good one is the design responsibility. So there'll be a design that's probably progressed up to construction drawings, maybe a bit further, but because it's potential that the design team haven't been paid as well, that there's no collateral warranty or any warranty in between, so you can't get the intellectual property rights, depending on how the appointments were put together by the original developer, won't be in a position whereby it can sold. It could those design documents can be sold.
All those are familiar, Mark. In fact, we haven't had any design type issues on this, and we have actually got some building control sign off, but we've not got anything else. So it is very much we put it to the market. We very much on a caveat emptor basis. And in fact, we've now got offers on that. We've stress tested those offers as against the build out option, which we could still do. And it just wasn't covering the margin, creating a sufficient margin to make it worth the bank advancing the additional the additional funds, which is sort of well in excess of £1 million. So we're actually taking the low risk approach on this and selling those 10 sites as they stand to a new developer who will take it on and finish it off.
And you mentioned before, you suggested that's probably a 20%, 25% discount on what the.
No, that would only really apply to the 5 houses that needed the modest amount finishing on them, because why would somebody want to buy 5 nearly complete new houses? Either to rent them out, in which case they'd look at what rents they could get out of them, and that wouldn't justify owner-occupier vacant possession values, or they'd buy them in and then just sell them on and make their 15, 20%, 25% turn on selling them on and after finishing them off. It's with the way we looked at the two aspects were what's the risk profile, and where do we maximize the value? And we wouldn't maximize value by finishing off phase 2.
We're getting close to the end of time, and I'm conscious we've still got a lot of materials to get through. Colin, what I was going to suggest, and just for a note for everyone who has pre-organized meetings, if you're all right to bear with us a few minutes, as always, we all get into a lot of content and a lot of detail that we like to explore as well. So hopefully you're all right to push your times back by sort of 7 or 8 minutes, and those will happen. Juliana has messaged you all to let you know which time your pre-arranged meetings will happen and on which tables as well. So we'll cover that in a second. And one of the things we can do, Colin, if we don't get time, is I can send your final notes out, which are the recommendations to everyone who's looking at participating in the space in terms of things that they need to know. And I've looked at them here; they are quite comprehensive. Are you happy to go on to the next case study?
What I might suggest, well, I was actually thinking, Alex, the next case study is really more of a residential investment situation, which probably isn't so relevant, and probably if I flip onto the sort of comments on buying from a receiver, which are largely bullet pointed there anyway.
Colin, give us 1 minute, because there is a couple of the developers here that do look at residential investment as well, and have sort of adjust their strategies. Just give us a quick whistle-stop tour for 1 minute, if you can do, on the Liverpool project.
Yeah, this was a portfolio of 24 individual properties. We were appointed December last year. So really didn't get our teeth into it until January. Our first question in looking at these sorts of things, and we've had numerous of them over the years, are: where's the value? Do we sell it as a portfolio, or do we sell it? Do we break up the portfolio, or as it stands, and sell it individually? I can think in the last 15 years, so covering back to the last recession, there's only one case that I can remember where we actually sold up a portfolio, and in fact we broke that into 3 separate sections, because it generally does not create value, and we will generally go down the route of selling off properties individually, which is what we did here, and this was relatively straightforward. Usual mismanagement issues, other than we hit the market in March, and it was very interesting through the period from March almost up to today, really. We have sold all but 5 of these properties, so we've sold 19 properties since March, with the exception of 2, which were with vacant possession, and we offered through local estate agents. All of them have been through a virtual auction, which is quite interesting to watch, and it was about the only entertainment in April. No football, no nothing else on the telly.
Well, you were part of TrustedLand at that point as well. We had some great sessions. So Mark was involved in one of them.
So the crux of this is we did the numbers the other day. We've got exactly, in terms of realisations, what we expected 12 months ago, which suggests there hasn't been any effect on the market of COVID, because we've been selling throughout the COVID period. We're down to 5 that are left. 2 of the higher value properties, which we've got vacant possession of, and we're selling to owner occupiers, and we've just got 3 bloody minded tenants that haven't paid rent for 6 months, have said they've accepted housing benefit, and are just blocking our sales. So they're getting the possession orders this week. So that's the only reason we haven't sold those. So that's very quickly the process that we've gone through there.
Let's round off with your recommendations, because these are important points as well, and I think it's always good to hear it directly from someone in the professional space. And sorry to everyone for for overrunning slightly, but it's important content as well.
That as mentioned earlier of administrators wanting to deal with things quickly, and I think that is generally the rule. But I think generally,
can you move to the last slide, please?
Administrators are looking at a company sale, and often leasehold properties. Therefore, speed is of the essence. When you're looking at a property receivership, whether that be in me acting as an LPO receiver, or a administrator liquidator of a property company, the asset is there. It's not walking away, and there isn't generally a need to achieve an immediate sale. There's a greater desire to go through a due process, assimilating information, then deciding how to best market that property, sell it through an open process, so that the process is transparent, and frankly, the receiver can put his hands up and say, I've done the best job I can, given the circumstances. I've done the best for the bank. I've done the best for all the other creditors. I've done the best for the shareholders. And I think there's a bit of a misconception that just because it's a receivership sale, you want to sell it the day after you're appointed. Frankly, the contrary is the case. Even if it's a terraced house in the example I've just looked at, I'll be wanting to look at to put that in an auction in 2 or 3 months' time, having fully understood and got the situation, than selling it to the first person that knocks on my door. So there's not a lot of benefit in pressurizing on offers. And, you know, I've got two at least in my, that ring me every time I send particulars out saying, I'll offer you 25% of what you're less than what you're asking, and I'll do it tomorrow. Well, the response they get from me is normally fairly short and shaft.
Colin, I feel like this is, and I'm going to think a little bit off the cuff here because this is some important content, and I think what you just said there is probably where some of the people we'd spoken to early in the year, their perceptions were in terms of how the process works. If they can turn up with a bit of funds and say, listen, we'll do a deal, I know you want to move on quickly, then it's, you know, then that's the deal done, and they'll pick up a great value asset. Could I ask you, would you and I be able to do a sort of 5-minute session as a cutaway? We can record another time, and I want to share this with all the attendees here because it's important. I don't want to rush you through it as well. We are running out of time, unfortunately, so I just don't want to. I think you've got a meeting. I think Mark's got a meeting we've arranged for you as well. Would you be right if we did a separate session?
Yes.
And you and I can spend 5 minutes. We'll do it in its entirety. We'll give it the time and respect that it needs because there's a lot of detail there that I think even your last point is a big part of the misconception. So let's do that if you're right, and we'll round off for today's session just so everyone can go to their pre-arranged meetings. And we'll follow up on that in the next couple of days.
No, I'm fairly free. Tomorrow morning I'm tied up on another presentation, but other than that, I'm fairly free for the rest of the week.
Well, listen, I'm sure there'll be a few people want to ask you a few questions as well. And sorry we didn't get through more of the content, but Colin, thank you very much for putting that together for us as well. Thanks for sharing with us and taking us through some strong detail of what is a complex space. And Mark, thanks for supporting me with some more advanced questions in terms of the construction space and giving us your views as well. Ladies and gentlemen, we are going to break up the session for today now and go into the organised meetings. I apologise, we are running behind schedule. Juliana has messaged all of you to let you know which tables you'll be on for your one-to-one meetings. Let's say they happen at 5:30, so they're 10-minute pre-arranged meetings. The rest of you, you can sort of hang out on the lounges at the front tables. Please stay away from the tables at the back, which have been allocated for the private meetings. If you have been set up with a private meeting, please, you've got about 2 minutes. If you can head there very, very shortly. And in terms of the formal session, we will see you all again back in January. We may have a little bit of a Christmas special for you. We'll announce that very soon. But Colin, Mark, Richard and David, thank you very much for sharing with us today. And I'll catch you all soon.
Cheers, Alex.
Thank you.